Hey there, everyone. Happy Friday, May 23rd, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully cool, overcast, but lovely green Redmond, Washington. Hope you guys are all doing well. Choppy start to the session today. I was doing IBD live right around the open this morning here on Friday the 23rd. Market gapping lower at the open after the newest and latest tariff announcements. We're recording this sort of midday afternoon in Eastern time. Since that lower open, the market has actually sort of chipped away on the upside and made some upside progress. Not quite regaining Thursday's close just yet, but certainly improving a bit. From a technical perspective, right? I think it's all about the 200-day moving average, that 5750 level, as we've covered many times. Here on Friday, we're going to do an all mailbag episode. We're going to do a quick market update. Then we'll take some of the great questions we've received from you guys through the course of this week. Wishing you a very happy holiday weekend. Happy Memorial Day to all of you on Monday. Hope you find a way to celebrate that, both those of you here in the U.S. And we'll be back. We'll be off on Monday and be back on Tuesday with our next episode of Chart This with Dave Keller. So looking at the averages, we can see, decent action going into the afternoon after this morning's lower open. Certainly felt like, pre-market, the futures gapped down pretty aggressively as things opened. It certainly felt like a test of the 200-day moving average was not going to go particularly well. Now through about 2:30 p.m. Eastern, appears to be holding all right. As we mentioned a number of times here recently, think of the S&P chart like a stoplight above sort of 5750, 5800. Good chart, good strength. Between 5750 and 5500, we'll call it yellow light, more dangerous conditions, questionable uptrend phase below 5500, red on the stoplight, time to get out of the way. At least that's how I'm thinking of it. So the fact that we sort of are trading at or slightly below the 200-day moving average, but pushing back above it, pretty encouraging finish to the week here. If it does hold going into the weekend, I mean, that's the level you got to watch next week. Got 3 days of potential news headlines, of course, to be hit, but we'll see what happens between now and then. Kind of surprising in a lot of ways. The market didn't gap down a lot further. It certainly didn't trade lower through the course of the day. That's not bad. That's actually pretty encouraging if you're on the bullish side. It tells you that the market has sort of priced in, maybe, I guess, some of that potential negativity. Again, I'm surprised the market's holding up this well, given the prospect of additional tariffs being floated around here. It certainly feels to me like investors are underweighting the impact of tariffs, or at least questioning that they're going to be sustained or actually implemented, and then it's more smoke and mirrors. We'll see. For now, the S&P currently around 5826 here. It's down about 1/3%. That's not bad. The NASDAQ down a little bit further. The VIX pushing a bit higher today. Obviously, quite a noisy couple days here. So the VIX looks like it's going to finish the week above 20. We'll see again between now and the close at 4 p.m. Eastern if that changes. But the VIX over 20 tells us at least we're in a bit of an uncertain volatility environment. Now, the big story today, I would say, in terms of intermarket analysis, bonds pushing higher, rates coming down. 10-year yield is around 4.5%. The long bond yield still above 5%, but not by much. The dollar weaker today. Precious metals continuing their upward climb. The GLD is above 310 as gold pushes higher, over 2%. Silver, copper prices all up. Energy prices looking pretty good as well. Cryptos have been shopping around quite a bit. Bitcoin got all the way up to 112,000. That was, yesterday. Here in today's session, we're currently back below 110, just above 109,000. Overall, the chart of Bitcoin, pretty constructive here, I would say, overall, as we've mentioned many times. I think that long-term rotation, that push above all-time highs, pretty powerful follow through if we can get it. Looking at the sector rotation here on Friday, a couple themes that stand out. And again, I'll dig into these charts and themes a lot in a lot more detail from our Market Misbehavior Premium members over the weekend. Certainly consider becoming one of those if you want more of this, deeper analysis on how we're thinking, how we're positioned, and where we're seeing opportunities. You can find more info at marketmisbehavior.com/premium. Defensive sectors at the top of the list here: utilities, consumer staples, real estate, all in the top 4 sectors today. Energy is the 4th one. On the downside, you've got the FANG sectors: technology, consumer discretionary, both down, excuse me, over 0.5%. I think the weakness in those big mega cap growth sectors could be a potential issue. Breadth more negative than positive. All of these things not enough to turn our market trend model bearish as far as I can see. We'll see what happens in the next hour and a half of trading. And Netflix, the only one in the green today out of the Magnificent 7 stocks. Apple feeling it the worst with some latest headlines on their business, but currently down about 3% today after bouncing around through the course of the day. There's the S&P 500, bouncing off the 200-day moving average. I think that's, just vital. That's this gap, right, that we had earlier this month. The gap higher. We trade higher for another week. Now we've given back all of those post-gap gains. We're testing the 200-day for now. We're bouncing off the 200-day. The bull case is we bounce from here and push above 6,000. The bear case is this doesn't hold going into next week, and I'm going to see which way the market wins below, as it were. The bullish percent index on the S&P 500, we're going to keep an eye on that one as well going into the next week, because it does look like it's going to finish the week below 70%, which is out of the sort of overbought threshold and back into more of a normal range. Usually not a good sign. Again, we'll dig deeper into those themes with our premium members over the weekend. But for now, let's get to some of the great questions. As a reminder, every time we're live streaming the show, just drop a comment as you're watching. We capture all of those questions. If you're watching the replay on our YouTube channel, just put a comment below the video with your question. We'll gather all the questions that we can, put in the mailbag, and next Friday, we'll hope to answer one of your questions on the show. All right. Is that a head and shoulders pattern for XLV from January to April 2025? Let's take a look, shall we? So January to April 2025. So you're kind of looking at this period. So what's funny is as I bring up this 2-year chart, I'm actually seeing a huge head and shoulders patterns, about 1.5 years long. But I think you're talking from January, you're talking about this little period right here. And the short answer is for sure, right? That I would say that definitely qualifies as it. Again, what makes a head and shoulders pattern? Couple things, most importantly, the shape of the pattern: a head, a high surrounded by 2 lower highs. That's the head, the left shoulder, the right shoulder. A head and shoulders pattern should have some symmetry, meaning the left and right shoulders look similar. Sometimes if you see like the left shoulder and the right shoulder look dramatically different, it just means it's probably not that pattern. The idea of this pattern is that there's a symmetrical look to it. So you've got the left shoulder and right shoulder looking very similar in terms of price range and time duration. So that looks pretty good. You create a neckline using the swing lows between the head and the 2 shoulders. A break below that neckline basically suggests downside. Now, when you're measuring the minimum downside objective based on a head and shoulders pattern, what you do is you take the distance from the head to the neckline and you project that move. So let's leave that there. So that was that's there. And then we basically take a parallel break. So that means if we break through that neckline based on the height of the pattern, we should get at least to 136 on the XLV, which we certainly did. On that breakdown day, we certainly did. From there, we've continued to drift lower, getting down to as much as 128. That's not an ultimate objective. The way that Edwards and McGee, if you read the classic literature on price patterns, they call it a minimum downside objective. Doesn't mean we can't continue further, and we often do. It's also worth noting, if you would extend the neckline, that the counter trend rally after that eventual low didn't even regain the neckline as a resistance. So overall, healthcare has been a pretty underwhelming sector on a relative basis. I would say, yeah, that lower high and then the break of the neckline really validated a downside rotation on the XLV. I would say thumbs up. Agreed on that one. Next question. I recently heard the phrase rolling recession. Is there a difference between a rolling recession and sector rotation? Oh, no, that's an interesting question. Yeah. So, rolling, I'm not sure where you heard it, what the context was. So taking it totally out of context and just generalizing it, a rolling recession is basically means that it's more certain things are showing recessionary signs and certain things are not, right? So a true recession, right, means you've got 2 consecutive quarters of the GDP shrinking, GDP not growing. That's the definition, the textbook definition of a recession. Now, that usually takes quite a while before that can be validated, right? Months after the fact is when the data is actually available to say that it was a recession. So you see signs with a lot of areas of the market, struggling, right? A lot of the data suggests risk-off conditions. Companies are talking about, difficulties with growing earnings going forward. You've got lowered guidance, lowered estimates. And the price action certainly feels pretty heavy. You're not really seeing. You're seeing like plenty of signs of optimism right now in terms of plenty of things that are still going up. Is it like a leadership, a sector rotation, or a leadership rotation? Yeah, I would say that's probably different phrases to describe a similar thing. I would say a rolling recession basically means sector rotation, but some of the things that are not working are really not working. And if you look at something like energy stocks, they don't look particularly good. If you look at home builders, they're not good. They're not suggesting optimism and economic growth. They're suggesting that home builders are not a particularly good place to be. So I would say, fair that you could describe this as kind of a rolling recession where certain areas of the market look a lot weaker, and then you compare that to things like Nvidia or Palantir. These are not, we're in a recession kind of charts. These are AI is a pretty important technology that seems to be firing on all cylinders kind of charts. So you do have this sort of juxtaposition of things that look pretty encouraging and things that don't. So yeah, and your question wasn't, are we in a rolling recession? I think you could make the argument for that. And I particularly would say areas like energy that look remarkably weak. In fact, the crude oil prices are relatively muted. Things like home builders, which are more like bellwethers for economic growth, don't look particularly good. A lot of companies have had lowered guidance or have removed their guidance altogether, which shows a lack of optimism. But at the same time, I'm not struggling to find charts and themes that are going higher, right? And things that are improving, like defense stocks and General Dynamics, probably one of the worst defense charts, but starting to rotate higher, right? Maybe something like, Raytheon and others show this optimism about certain areas. So that's what a rolling recession technically means, that certain areas of the market are showing weakness as opposed to others. You're seeing signs of a recession in terms of the behavior and expectations with certain parts of the market, but not all of them. That's what that implies. And just like it's a slow roll, I think that's just a different way of describing leadership rotation, just the fact that it is not a homogenous market right about now. I think that's a fair way to describe where we're at. Great question. Next one, and this came after our podcast interview with Gary Antonacci, which we had last week on the Market Misbehavior podcast. So, are absolute momentum and RSI the same? If you listen to that episode, and if not, you absolutely should. Gary wrote a book called Dual Momentum Investing a number of years ago. He mentioned in the interview he's working on an updated version of that process and adding some of the research that he did for that book. And improving on this process of looking at dual momentum, which is absolute momentum and relative momentum. Now, relative momentum is where you're comparing ETFs or stocks or asset classes to each other. Out of these three things, U.S. stocks, non-U.S. stocks, and gold, which one is the strongest? That's relative momentum, right? Where you're comparing multiple things. And I would say relative strength, the series on the bottom of most of my charts, is an exercise in relative momentum. You're looking at how a stock or ETF is performing relative to others and ideally rotating into the strongest performers. Absolute momentum is looking at price momentum, is looking at how the stock is moving relative to its own movements. And I would say, RSI is not the specific methodology that Gary used in his analysis or that he advocates in his book, but I would say RSI is playing on the same themes that Gary is trying to capture when he talks about absolute momentum. Absolute momentum can be measured in terms of returns. What's the 12-month return on all of these stocks? And let me see the strongest ones. You could say, show me the highest RSIs, the highest scooter rankings on stock charts. These are all different methodologies, different momentum factors, I guess, of gauging the performance in a price series relative to what it normally does and looking for things that are improving the most. So yeah, I would say RSI is a way of analyzing absolute momentum for sure. Absolute momentum, I would think of it as like price momentum. Anything measuring the strength of a price movement relative to its normal movements. I would say that's fair. Definitely would encourage you all to listen to that interview with Gary Antonacci. It was awesome. Next question. You often mention candlestick patterns like hammers, evening star candles regularly. Can you recommend a book for learning candlesticks and their patterns? For sure. And I will tell you a true story. And again, sorry for earlier this week. I guess not sorry, but I randomly sketched out some candle patterns. They're here somewhere in my pile. At the end of the week, I end up with this ridiculous pile of things of notes like this of candle patterns that I drew on Tuesday or Wednesday's episode. I forget where that was to sort of describe different things. By the way, a couple of people asked me about that. I'm going to work up a blog post that goes through that in a little more detail, which I'll share next week. But with candle patterns, true story, I learned candle patterns reading a number of books years ago, and I think they're still very much the ones you want to read. Steve Nissen, last name Nison, wrote a couple of books on candlestick analysis. The main one, oh man, I'm going to blank on this, so I shouldn't even attempted to come up with this live. But I will research it and then share the link with you in the comments. So you're welcome to get it. Japanese candlestick charting techniques. There's another one called the Candlestick Course, which I have as well, but I didn't read that one first. The first one that I mentioned is the original one that I went through. Steve Nissen is credited with bringing candlestick analysis from Japan to the West. He was the one that introduced a lot of U.S. and North American-based investors to this concept of candlestick analysis, and now they're pretty much everywhere. It's hard to not find them on charting platforms, and they add a great deal, particularly if you're more of a short-term swing trader type of person. I think they're absolutely fantastic. So I think that's a good one. John Murphy's book, Technical Analysis of the Financial Markets, has great simple illustrations of candle patterns. I actually printed those out. I copied them and would carry them around with me in my bag. In the early 2000s, I'd be riding the bus or the subway to work, and I'd get them out and kind of turn them into little flashcards, just try to remember the names and think about what they meant, and then try to find them on the charts I was looking at during the day. So John Murphy book and the Steve Nissen book are the two that I would recommend. I'll put links in the with the show so you can get to those if you want to dig in a little further. And I would tell you that candlestick analysis is really fantastic, and I've had the opportunity to work with a number of Japanese technical analysts and money managers. I've traveled to Japan a number of times, and really have come to appreciate over time the value of a very rich visual form of technical analysis, which is what I would say candlesticks are. I mean, it's inescapable how special they are. If you ask why I don't use candles all the time, when you're looking at like a 2-year daily chart, this is the bar chart. If I switch it to the candle chart, I don't think it makes a whole lot of difference when you zoom out this much, right? But that's why I have this, chart there, which is a quick button on stock charts, and I call it candle focus. And it's just like I'm looking at the last couple months, and I just want to really focus on candle patterns, because I think that the fact that we had a bearish engulfing pattern on Raytheon on Wednesday, that's important. Now, as a long-term thesis, I don't think that adds a ton, but thinking about the day-to-day movements and the tactical time frame, I think it's absolutely crucial. So if I'm looking at a swing trading time frame, you better believe I'm looking at candlesticks. Longer term charts, I think it's less meaningful, but that's just me. I would encourage you to read books on candles and see if they make sense for you. All right, next question. For stocks that have been on an uptrend for a while, such as HIMS, CRWV, Rubric, how do you look for the turning point or the point to start selling? That's so interesting. We actually talked about a couple of these names on IBD Live this morning. That show, by the way, is a lot of fun, and I'd encourage you to check it out. I've gone on there a couple times before. I mean, just a really good group of market practitioners. Just great conversation. I love the discussions, laughing a lot. It is 6 a.m. in the morning when I start off with that one, so I was a little punchy. So I'm blanking a little bit on what all we talked about, because it was an early kickoff for me, but super enjoyable. But I know we talked about HIMS, and I'm pretty sure we talked about Rubric. I don't remember talking about CRWV, CoreWeave. This is more of a recent IPO from late March, but kind of similar. HIMS is kind of testing its previous highs. Rubik's kind of an interesting one, and we'll zoom in a little bit. I mean, just to look at, this is an IPO from about just over a year ago, April of last year, breaking out to new highs. So I think your question is, things that have been on here. Let's say you bought back here, and you're all happy about that, right? You're sitting on some great paper gains. What do you do now, right? How do you lock in gains and not completely give that all back if and when the price turns lower? So the couple ways you can think about this, right? And I would say the technical toolkit kind of gives you two options. Option number one, you use projection techniques to say, here's what happened back here. So I'm going to project where this uptrend should exhaust, right? Where should this trend end? I will tell you right up front, I'm not a huge fan of this approach. And the reason is because I worked with a number of money managers for a number of years that would never dream of selling something just because we hit some arbitrary price target up in the air above current levels, something that's making new highs. They'd say, look, I'm not touching this thing. It's my best position. So I learned that, so techniques that do help you do that, things like Elliott wave, Gann analysis, Fibonacci extensions. If you look into any of those, they are really part of those approaches are to try to project potential future highs or lows based on the framework we established before. I'm more of a fan of going with the trend following technique, right? The trend is your friend. I want to let my winners run. I want to let this continue to add to, I'm going to, continue to nurture this position as long as possible, right? So how do you do that? So, basic one that comes to mind is you look for a pullback to the 50-day moving average or the 10-week moving average. That's a common sort of approach. But the problem with something like this that's had such a quick run off of a low in early April is we're really far. That's a $20 gap from where we're at right now. It's like a 25% drop just to get to the 50-day moving average. Forget about the 200-day, which is all the way down at $56 a share. So with this kind of trend where it's getting further and further away, what I like to do is add a shorter term moving average. And I usually add a 21-day exponential moving average. That's the green line that you see here. And I don't do it all the time, but only if, let's say I buy something on this gap higher and it starts working and it keeps working and you're now compounding some gains, we're making new highs. And now you just want to make sure that you minimize your losses if there's a significant drop. I think the 21-day exponential moving average is a really good place to look at, and at least take a partial, take a partial position off at that point, right? So maybe take 50% off at that when we hit that, and then close out the position if we would go below the 50-day as an example. That's one way to do it. This one is a little more of a linear rise, but another thing you can do is look at those pullbacks as new stops. The problem is there really haven't been many pullbacks here on the chart of Rubrik. I mean, it's just kind of going vertical. So I feel like taking a steeper moving average, drawing trend lines would be another kind of technique, to just sort of track the move and then just try to minimize your giving back those gains if we would rotate lower. So that's kind of how I would think of a chart like Rubrik or some of these other like HIMS, like CoreWeave. Use like a 21-day exponential moving average, a shorter term moving average. And the exponential part of that just means it's more sensitive. So it's going to follow the trend quickly. The problem with the simple moving averages is that when the trend accelerates, the moving average really doesn't accelerate a whole lot because this is a simple average of the last 50 days. So what happened yesterday and what happened 49 days ago have an equal treatment by that moving average, right? Which is arguably not great. An exponential moving average weights the more current data more heavily. So whatever's happening right now moves the moving average more. And so when something's accelerating, the exponential moving averages will track better the acceleration in price. There you go. All right, last question, then we'll call it a long holiday weekend here in the US. What is your opinion on systematic trading strategies? Oh boy, this is like an hour-long webcast answer, so I'm going to give you the quick version. As a proponent of behavioral economics, which I am, do you think that automated strategies can have an edge, and how often should they be reevaluated? So I love the last part of your question, which is how often, should they be reevaluated? I would say, what's my opinion? It's definitely not my style, as you can tell. I am more of a market behaviorist. I love the subjective nature of understanding investor psychology. I mean, I studied psychology and music as an undergraduate, so I'm clearly not as much into the hard sciences. I'm more into the creative arts and more into how people think and feel and how that motivates their decisions. And I found technical analysis gives you a very systematic way of analyzing that. So I would say systematic trading strategies, I mean, if they work, which they often do, it's because the markets are driven by human nature. It's because the markets are driven by investors getting nervous and getting excited, getting desperate, and all of that being reflected in volatility and price movement. So I think there's a place for it. Could automated strategies have an edge? They certainly can. And I've worked with quantitative analysts and systematic traders who seem to have plenty of success with doing it. I would say most of the time when I see people trying systematic trading or automated trading strategies, they tend to be more short-term oriented by definition. If you look at some of the most successful quantitative money managers, hedge funds, right, that are Renaissance technologies kind of funds, they're super short-term, right? They're looking for very short-term anomalies and inconsistencies. That's not the time frame on which I'm primarily trading. I'm thinking more medium term and longer term. So I would say yes. There's a call for that. She was just watching some YouTube videos earlier this week with my daughter, my teenage daughter, who's asking me something along these lines, and it's so funny. I mean, to me, it's such a different way of thinking about market analysis to be looking for very short term. And just thinking of the markets as a series of numbers and just looking for those sorts of movements, but plenty of people attempt to do it. Having said that, how often should they be reevaluated? I think one of the biggest mistakes I see people getting into, and this is a common mistake, there's a joke that like I never seen a back test that I didn't like. There are often things that back test beautifully, right? And it is very easy to get sucked into. I create some system. I look at a ton of historical data. I come up with some approach that tests really well based on what's happened. Okay, I have cracked the code of the markets. I'm just going to have this automated system trade. And then what often happens is you put real money behind it and it just absolutely implodes and doesn't work and you lose money. And what you have to remember is anytime you're looking at historical data and anytime you create some model about what should work given that those particular data points, you are making a huge assumption that tomorrow is going to look anything like yesterday, right? You are assuming that tomorrow is going to have a similar vibe to what worked before because those are the inputs in your model. And a lot of time what happens is market structure changes, right? Things are different. If you look at 2025, it's similar in some ways to other years, but it is an incredibly unique year. So using some model that worked really well in 2024, I don't know how well it may necessarily be working in 2025 because things have changed quite a bit, right? Because the volatility has changed, all sorts of things have evolved. So I would say the process of reevaluating should be pretty consistent, and never just setting up a model and assuming that's all I need and that's just going to work and churn out returns for me. That's not what I found successful. So those were some high-level thoughts. There are some places I would suggest you look, and I'll put some links below for these books. One would be Investing with the Trend by Greg Morris. That's a great discussion about trend-following tools, about systematic, technical processes that are more along the timeframes of what we talk about on our show and in our work with our own premium members. The other one would be Evidence-Based Technical Analysis by David Aronson. I've had good cocktail hour debates with David years ago. He approaches the market more like an engineer, more like a mathematician, looking for provable, data-oriented theses, which I think is in line with your question. I was taking the softer behavioral side of market analysis. I think there's a place for both of us, and I think there are ways that both sides of that coin can help you to better understand the markets and better position yourself for success. But those are two books that I would suggest that could help you put some detail behind some of the sort of broad generalization comments that I just made for you. That'll do it for this week, guys. Thanks so much, as always, for some really thoughtful questions, some great comments during the week as we do our live stream, and for keeping this discussion interesting. Really appreciate all the great feedback that I've received. Keep the questions coming. Again, all of these questions came from people like you in the last week as we go through the normal process of analyzing the market. So if a question comes up, pop it in the comments section wherever you're seeing the video. We'd love to hear from you. Have a fantastic long holiday weekend. We'll be off on Monday for Memorial Day, and a happy Memorial Day to all of you. We'll be back on Tuesday, the 26th. Have a great weekend, and remember, it's always a good time to own good charts. Take care.